Bitcoin to go higher and to offer Bitcoin services, and ETF inflows were a record last week. Lots to talk about. Scott is actually en route to Token 49 in Dubai. So it's going to be Larry Lepard, myself, and Mike McGlone this morning on Macro Monday. Let's get to it.
Let's go.
Well, we got a lot going on and a little going on at the same time. Not a whole lot this weekend. We're still in the markets are done with their tariff tantrum, but the real economy looks to be suffering a bit. Could be money printing incoming. Who knows? Why don't we get started as we always do, Mike, with the morning meeting? What did the doom and gloomers say this morning?
Well, it's a good lead up, Dave, and hello to you and to Larry and to all our listeners and viewers. First, Toronto Wong pointing out the GDP nowcasts from the Atlanta Fed have been posting negative numbers, even if when they take out gold. Their outlook is for GDP is around very, very weak, around 0.4%, but it's looking forward was the key thing that really struck me. She expects this payroll number to be decent. She's above estimates of 165,000. And 4.2%, that's the consensus. But it's the next months, May and June, she thinks will be very weak. It's logistics and trade, leisure and hospitality, they're just collapsing. Plunging was the word she used. So looking forward, looks bad. ISM, she's expecting 48.5 from 49. Gina remains still quite bearish. This is impressive for me to hear that from Gina because I thought she was a permeable for a while, and I realized she's not. Her points are key thing on the way up. We've covered most of the gaps. We're back to long-term downtrend is what she thinks. Still well below that the 200-day moving average in S&P 500 around 5,700. But the key thing she pointed out is guidance is at record levels, lows. There's a record number of sales misses and margin expanses has flatlined set to contract. That's the key thing. Key and from the majors, and then Audrey, our FX strategist, pointed out she thinks we've reached peak tariff negativity for now, which is part of the reason I think gold has a pretty good peak at 3,500 for now. We'll see where we go for the next few months. Back to you.
So the real question, Larry, this one's for you. The real question in my mind is the Fed always reacts to published data and makes them late. They've been late on pretty much every move that they've done in, I don't know, forever, except for this past summer where everyone looked at it and said, what the F are you doing? The entire world expects these numbers to be better. I've heard you're not the only ones who are above consensus. I mean, job numbers look great, but if you talk to, and I mean literally anybody in the real economy, you hear tales of, oh my God, I'm about to lay off these number of people. It's all of what's about to happen because of all the people buying stuff brought forward in order to take advantage of the fact that tariffs haven't kicked in yet. So the question is, does the Fed look at what's about to happen and say, oh my God, or do they wait for the actual print that says, that jobs, new jobs are a minus number in the hundreds of thousands, and they look for unemployment to like explode over 5.5%? I mean, do they wait for that, or do they actually have anything that could be predictive?
It's a great question, David. I don't really know the answer. I mean, they should anticipate, but often, as you say, they haven't historically. And they might want to wait for the print. I mean, it also goes a little bit to the politics of the situation where it's pretty clear Powell doesn't want to help Trump, and Trump has been nasty about Powell. So, at the margin, Powell would want to be a tough guy, and he wants to kind of hang on to his potential reputation as a Volcker, which was really the inappropriate thing to be in this circumstance, but that's what he's trying to do. So I don't know. I call it a coin toss. I mean, I think if you go to CME Fed Watch, you see the odds are pretty small that they do anything in this next meeting coming up. And I guess I'd have to go with that,
Yeah, that's what it feels like to me. I mean, Mike, given that everything that Gina's describing and all your economists are describing looks like there's a train, you're watching the train, you can see a half mile ahead that there's an end to the tracks and it's going into a canyon. And the markets are effectively looking at this and saying, I mean, what do people make of this? Do they think people are just dumb, and that they're waiting for the actual bad news to show up, or what's going on? We'll get to Bitcoin in a second, but just in terms of the stock market, it looks very
Let me go
blasé.
first, Mike. I'm sure Mike has a view, but I have a strong view on this. I think people still are locked in the buy the dip mentality, looking backwards. That Trump is going to, he's not serious about these tariffs. We'll negotiate with China. Everything will be okay. He just grabbed a lot of turf. And I still think there's a lot of happy talk and a lot of happy, I think Wall Street is deluded about how this is going to turn out. I think it's going to turn out worse than Wall Street is currently pricing for. And so I'm very, very bearish, at the 5,500 level. I don't think we'll even see 57, the 200-day moving average. And I think we'll take out the April 7th lows, sometime in the next 30 to 45 days. That's my view.
And I guess I have to say, darn, we agree almost completely, which means one of us is probably going to get stopped out first, and then it goes that way. As trading bear markets, it to me feels just like 2008. I just remember in July when that price of gasoline, average price of gasoline went above $4 a gallon. That was it, and I just added to short positions. But you had to take pain first, and to me, that's what's happening with tariffs. Now, our economists point out, yeah, it's inflationary, but 2/3 of most of these inflation numbers are services, and they're starting to get hit hard. But I think that's the key thing is we're in a transition. My view is this is a bear market this year, and I expect the S&P 500 is more likely end the year down 20% than up maybe even 5 to 10%. And it's just normal reversion that's overdue. But we're in that stage where, yeah, you can't. And also, we've had the first salvo. We've had gold tell us there's a problem, and it got too expensive. It front run the market. We had the stock market go down, tell us a problem. It has to bounce back. And I think we all agree, but Larry knows, we know how markets work. This is something that people haven't really seen, mostly the junior traders, for 15 years. I just remember the last two 50% drawdowns, the S&P 500 the last 25 years were very good years for me when I was trading, just because I recognized the things I pointed out last year. The key thing I want to point out this year so far is if you look at your statement, this is a lesson I learned from you ever Market Wizards? Charlie DeFrancesca. He was one of the key guys in the trading pits. I knew he died a long time ago. He pointed out the key thing that matters is your statement. It doesn't matter if you have a view. It's what that statement says. And so far in the year, I see virtually every stock market index is down. I see gold the best performing. Crypto's actually Bitcoin up 1% or 2%. Most crypto markets down 15-20%. And everything else is just down. So from a trading rational standpoint, from a statement point, most people are losing money. Traders, though, are loving this. I just look at this as a great trading environment. We've bumped up to good levels. Maybe we get higher. Bitcoin is a great leading indicator. That's why I thought this first bounce to unchanged still is worthy of a short. And that 60 VIX is a great buy. And now it has to prove where it's going. But overall, the big picture macro is I don't think it's proven yet. Maybe by the end of this week, people will see something to prove it. But the bottom line is nothing really matters unless risk assets go down. And I think we're way overdue for that normalization. So I end with the key thing I think that's happening. Stuff Dave and we all discussed 2 years ago is when the Fed eased last year, that was on the back of, first of all, they stayed too low for too long. The prices, everything went up, and now everything's gone up too high. And they eased when the stock market was on a tear. I think they made a mistake and just added another 1,000 points to the stock market. Now when it goes back, and to inflation, now when it goes back down, it makes pain worse. And we all know cryptos are the leading end of risk assets.
Well, okay, so let's look at that, because the market, I think, has been telling us something differently over the last 2 weeks, and what the market's been saying for the first time in a long time actually is logical to me. Now that's a really interesting thing, because markets are rarely logical when you're in the market, and then you look back 6 months after whatever you're talking about, and then all of a sudden you go, okay, that made sense. Because in the short run, markets are crazy. In the long run, they tend to get things right. So if you think about what's actually happening, right now in the stock market, I'm with you guys. I hate to agree with you, but I think the trade is if I were a macro hedge fund, I would be short the S&P and probably the NASDAQ, but definitely short the S&P, probably want to focus on the manufacturing sectors and the things. Maybe big tech is going to catch a bid, the same reason Bitcoin's going to catch a bid. But you're going to see the real economy get hammered. You're going to see liquidity conditions improve. Powell may hate Trump, but he doesn't like unemployment, doesn't want to be at the steward of a depression. So, it's a game of chicken that in that particular case, Trump will win, but it'll be whatever it's going to be. Maybe he lets it happen first. But in any case, corporate earnings, which do matter for stocks, are going to get hammered. I think we all agree with that, right? But on the same token, liquidity is going to come in. So I think the trade is short S&P, long a basket of gold and Bitcoin. Bitcoin for the adoption curve that's happening, and gold because gold is literally that, exactly as you say, Mike. I mean, it is what it is. And to me, that's the actual macro trade. Now, we can talk about why I think Bitcoin is going to be more like gold and exceed it, and we can get to that later. But when you talk about notice I'm not talking about the rest of crypto. Right? I'm talking about Bitcoin right now. And I think Bitcoin dominance will increase during all of this. And yes, there will be some winners in crypto, like there'll be some winners in the tech sector. But the truth is, if the real reason the markets are going down are because earnings expectations get crushed, that really will just massively increase liquidity and not necessarily hurt assets like gold for sure, or Bitcoin, which is effectively been trading more like gold over the last few weeks. And the reason for that is there are more people who are investing it that way as a thesis. I mean, Larry, you run a Bitcoin fund. I mean, you talk with investors every day.
I agree with you. I mean, I think people, and James, who's not with us this morning, I'm sitting in for him, had a great thing in his Substack or in his, information this weekend where he showed this really separation is beginning to occur. I mean, we're seeing stock market down, Bitcoin up. So this Bitcoin is no longer just a widget on the triple Qs. One thing I will comment on, back to the Fed, the Fed cutting last year, to me, that was just clearly political. They did that to try and help, the other team win the election, and it didn't work. And I look at the CME this morning, it's an 8% chance they cut on May 7th. I mean, I think what's going on here is I actually think Bessent and Trump are going to force the Fed into cutting. They know that Bessent's not stupid. He knows that what he did would tank the market, and the market is a bubble. It's a bubble, or has been a bubble, created by ZERP from 2009 to 2015 and 2019 to 2022. I mean, they're just enormous distortions. I mean, Hussman's done the work to show that the valuation of the stock market is higher and more overvalued than it was in 1929. And coming out of 29, it fell 80%. So I think there's nothing but downside risk in the stock market. When I see people talking about the Fed's going to cut and we're going to go to all-time new highs. I mean, Mike, you and I both remember, I'm sure you do too, Dave. I mean, in the last two bubbles bursting, 2008 and 2000, the Fed cut all the way down. Didn't matter. When a bubble bursts, it bursts. And so I think this is a bubble bursting. And I'm very bearish on the stock market. I think the stock market ends the year down 40%. It's my personal view. But, what do I know? I mean, it could be wrong. Back to the Bitcoin thing. Yeah, I mean, Bitcoin, it's interesting, as we've seen, and some good charts have shown. My partner, David Foley, put one up about a month ago. It's on our thread that shows that, gold tends to smell debasement before Bitcoin. And so, gold just got on a tear, and, it's up 60% in a year. It's very, very rarely ever done that. I mean, really rare. And it's probably overextended, but Bitcoin was kind of flat during that time frame. And now it's playing catch up. And often what it does is it catches up and it goes further because it's more volatile. So I see Bitcoin at 140, this summer. I'm very constructive on Bitcoin.
So, Mike, obviously, music to your ears. You've been talking about market cap to GDP. What happens if the GDP does what your economists are thinking it's going to do toward the back half of this year? That market cap to GDP number, if the stock market doesn't come down significantly, I mean, what are we going to get to 3?
Well, that's part. I mean, that's the key, I guess, sore thumb on the global market is we have significant deflationary forces out of China. That's known. Everybody in the world is pushing back on their exports because they have to, and they're just front loading. They're loading their exports on the world. Remember, we've seen this from Japan 30 years ago, and it wasn't nearly as big. We have significant deflationary forces in things like crude oil. It's all heading that lower, and you see it in gold doing the opposite. And the sore thumb on the global scale for that deflation from the inflation, which is all lesson history, is that's how you get it. You have to get inflation first, and then you go to deflation, is the U.S. stock market. But it's not just GDP. It's versus the GDP of stock markets of the rest of the world. So I like to watch this S&P 500 versus MSCI ex-US index. From 1968 to 2013, it was basically 1-to-1. And then it jumped up to 2.1 in the last 10 years. That's starting to head lower. And when it becomes prudent on a global money management basis, it's hard to dispute this. And Dave, I think what our listeners want us to do is disagree. But if it becomes prudent on a global basis, just manage your money. When you're overweight the U.S. to sell that, that's a problem. And I think that's what's just happening. And I agree with you completely.
Yeah,
one of the best ways to get the Fed to ease, to get inflation to go down, to get somewhat deflationary forces, is have the stock market back up 20-30%. And it's way overdue. And then by the time we get to the midterms, have it stabilize and start heading higher, and then point out all this investment into the heartland, which is, by the way, I'm not going to tax your wages. I'm not going to tax your overtime or your tips. It's going to get the votes. It's a great setup, I think, but the key thing that the primary thing I'm still expecting is this all makes sense to me if we get that finally, at least maybe a 1/3 drawdown, which is an S&P 500, which is the base case of economics and Bloomberg intelligence. But the kind of thing I just need to point out is that, to me, is a very unlikely case where Bitcoin's going to outperform gold. So I point out in the year, gold's still up 20%, Bitcoin's basically unchanged. And I look at this level here as, okay, prove it. This is a lesson I learned in trading bits. You get to key level, you see, prove it. Prove that strength. So far it is. I have to agree with that. But let's get through at least these week's numbers.
Yeah, I think that that's important to look at a couple of things. So let's talk about I want to shelve the Bitcoin conversation for a few minutes as we have some time to get there, because both Larry and I are going to hammer at you, but for different reasons, different things. But let's
come on, make some better discourse.
No, that's cool. But I think it's important to understand that what we're all basically trying to tell people is that the global macro situation is not pretty because of what's happening. But I think it's really important. You keep saying something that I think is demonstrably wrong, but demonstrably wrong. I agreed with you up until probably 2 weeks ago, which is that the way to force the Fed's hand is the stock market. I don't think Bessent even cares about the stock market. He came out on this weekend again and said the same thing. What he said this weekend was really important. He once again made it exceedingly clear that he cares about the bond market. He wants the 10-year down. I don't think he cares in the short run about the stock market. Everybody, I mean, Trump does, because, people yell about it. It's like Bessent made the point this weekend, which I think was fascinating, where he said in this interview, the one that I saw, he said two things. The first thing he said was, listen, the stock market is more or less unchanged from where you people all screamed about we're having a crash. And the media, as far as the average person knows, the stock market is still crashed if they haven't looked at their own 401k, because the media said it crashed and they never said it recovered. And the reality is it recovered almost all the losses. April is actually unched, and today we're basically unchanged. So, they're looking at the media and they're kind of shrugging their shoulders. But in the same interview, he talked about how important it was that for the U.S. long bond. And that is important, and that's what he's fixated on. So I mean, Larry, what do you make of that? I mean, what are his tools? Because this morning, what are we at? 4.3. We're still in the same range. There's no panic, but it definitely a bit of a hit over the weekend.
Well, clearly he cares about the bond market, but and when the stock market took its initial dive, the bond market caught a bid, and the 10-year came down into the 3.8 area, but that didn't last long and started going in the other direction. And they're really kind of trapped, as we all know, and that's somewhat of a problem. Let me just add one other thing on the stock market that I think some people haven't really focused on. Our stock market has always been the world's best stock market, and there's an enormous amount of foreign capital in our stock market. There's a net $15 trillion positive foreign, investment balance in our market. And another thing we haven't mentioned at all is that in the first quarter, the dollar also went down 10%. So you're a foreign investor and you own U.S. stocks. Your U.S. stocks go down 10%, and then the dollar goes down 10%. Well, you just lost 20% in your local currency terms. And so I think one of the things, and I've seen some numbers that show that a lot of investors are losing confidence in the United States. I mean, you see the people in Europe aren't taking trips here anymore. I mean, this Trumpian, throw a grenade into the party strategy, see where it all lands, create a lot of chaos. I mean, I get it. There are those who say it was a smart thing to do. He's got to break the glass, got to grab a lot of turf. The flip of that, though, is you create so much uncertainty in your own currency, your own markets, that everyone decides, hey, you know what, the U.S. isn't a safe place to invest anymore. And this great, equity growth market economy that we've enjoyed kind of goes away. And, we know a couple of things. We know the top 10% of the population accounts for 50% of the spending. We also know the top 10% of the population owns 84% of the stock market. So take the stock market down 40%, and guess what? That top 10% looks at their retirements account, looks at everything else, and says, I'm not going to buy the extra car. I'm not going to, rent the house. I'm not going to, they just cut back on everything. And so I think Trump and Bessent are thinking, well, this is okay because they aren't the ones who voted for us. We're out to help Main Street, the bottom 50%. And that's all fine until the job losses start, and then Main Street's going to get hit too. So, it's a toxic brew. And I think, the thing, my personal view is they overplayed their hand, that China is going to make them pay for it. I mean, China, you notice how Trump said, well, we're going to talk to China, and Xi's like, we haven't talked to them. We're not, China, we entered this fight with a glass jaw, which is our financial markets, which are highly levered and very, very unstable. And, they entered the fight, and they think in 50 and 100-year time frames. And so, they could make us suffer here pretty badly, in my view, if they don't come to terms with us. And, the world enters a very serious business downturn. I mean, we go back to the Smoot-Hawley stuff in the 30s, and when that came through, I mean, what it did was just devastating. And, we're seeing, container shipments just kind of go to, trend towards zero. That's not good. And, in a highly levered economy like the one that we have, this stock market to me is just a disaster waiting to happen.
So one thing I love that Dave points out is the Smoot-Hawley came when the U.S. was a net exporter. This is the difference now. Yeah, I think the historical context of what happens, number one, was not ever underestimate the self-correcting mechanism of the U.S. If this doesn't work out come midterms, there'll be pushback. Come next election, Trump's gone forever. We switch back to the old days. We're fine. If it works, it'll set the stage for the next 100 years. So I think it'd be very unsmart to underestimate the United States in this space versus a country that's led by one person. That's China, one human being. There is absolutely no self-correcting mechanism, and you're seeing the issues now with what happened with housing getting too expensive, and you just can't stop the thing. I love when Treasury Bessent points out the Mickey Mouse thing with the broomsticks when he's in Fantasia. That was Sorcerer's Apprentice. There's an unstoppable force right now of that supply and coming out of exports coming out of China. That's the same thing I see in cryptos, but that's another story. It's just obviously I'm American, but just point out the facts of history here. China is very much worse than Japan was when they peaked, and heading that way now. Where are they going to export? They're toast. I mean, just good luck. Let's remember what happened. This is the last 50 years, the U.S. being the benevolent, biggest demand pull country in the world that charged zero tariffs. That's just changing, and it had to change. It has to reset this global balance. But let me just finish with that thought here. This is happening. I think it's going to be good in the long term. In the meantime, the self-correcting mechanism. The main point is we all agree on it means the main thing that people did for the last, who knows, decades it was like I learned from another person I'll mention from history, John Licio. People who remember him was a great journalist, economist, pointed out traders in the pits were dope-sniffing dogs, but that's what capitalists are when it comes to profits. We were dope-sniffing dogs. We found any way to enhance profits. That was offshoring. Now it's going to go back. So the key thing is getting any profits. The key thing I want to point out is I don't see how we get through this without just some normalization of U.S. equity values. We all kind of agree on that, which means everything goes down. But I will agree with what we all said is what Bessent's view is. To me, if I keep saying the same thing, and maybe eventually we'll be right, gold was the last big trade for a while. Bitcoin was a great trade for quite a while. I think it's just overdue for some normalization. That's where we can disagree a little bit. It's just it's too expensive, too high. To me, the next big trade is that normal deflation where U.S. Treasury long bonds will be the next big trade. And guess what? I've been wrong for a while. I admit that. A lot of people I know, the smart people, have been wrong. So I'll end with one other person, another market wizard, Marty Schwartz. I started in the trading pits in 1988, and I remember executing for him on the night desk. He started getting bullish. He had got a bunch of money. He was trying to buy long bonds. He was early. He was wrong. He got stopped out. And the next year he started getting in, and he did great. Just a little lesson I learned is, okay, he was early and wrong. He was leveraged, which Dave knows you should never do, but I come from that environment. But he got stopped out, and then he went back in and did very well. Just this is what I think is what's happening with bonds right now. Yes, I've been way early. Keep saying the same thing, but I think they're just going to drop 200 basis points and get towards China, which is 165.
Wow. So see, Mike, I would in a normal backward-looking environment, I would say you're completely right. But I think the rules have changed in the sense that, and gold is telling you that the rules have changed, and the rules have changed because everyone fully understands that the governments are trapped and that they have to do the big print. Somebody should write a book about it. And since they understand that,
yeah, since Larry doesn't want to promote the big print, hold on Amazon.
And since they understand that, they know. I think more and more of the bond market is becoming aware that they're the sucker at the table. And you know, I mean, it's going to take some time because right now, I mean, the government's not printing much. I mean, but that, as we all know, I mean, one thing the Federal Reserve you can count on is they will change on a dime. I mean, they weren't even thinking about raising rates, and then they did the fastest cycle ever. Do you know what I mean? And I mean, at some point when this gets bad enough, they're going to turn around and go back to ZERP and QE, and your head will spin, right?
So here's the question. If, let's say for the sake of argument that you're right, Mike, there's a logical inconsistency in what you just said. And let me point it out. In a world where the U.S. bond brings long rates down 200 basis points, corporate earnings are suffering because we're in a real economy recession, to think that Bitcoin's going to stay correlated to the stock market is silly. And it's silly for two reasons. Reason number one is, even assuming Bitcoin is at its mature asset and it's essentially trading, you know, around where its size is relative to gold and Bitcoin are more likely to be together. But the second reason is adoption. And we always ignore that. You know, most of the people who are buying back, and I say this every week, but it's really important because this isn't just Michael Saylor anymore. It's not, you know, he's not some dude wearing, you know, some billionaire kind of Zen master wearing, you know, Yoda robes and, you know, acting like a Jedi saying, the Force says Bitcoin's going to be a million, 10 million, whatever dollars. You know, it's not just him. There's 80 companies with Bitcoin on its balance sheet. There are multiple sovereigns mining and getting into Bitcoin. There are 20 bills for states buying it. And most of the people, the smart money people who are buying it, are doing it because they see, and here's the words that I've been using for 3 or 4 years now. It's an asymmetric potential return to the upside, not symmetric, asymmetric. As long as that's the belief, unless something happens to change that belief, i.e. a 51% attack or something that changes it, that matters. And it matters to the way people particulate. Now, even if you don't believe Bitcoin's going to outperform gold, the fact that people are buying it as a hedge or as an outperforming mechanism vis-a-vis stocks, you have to credit that is true. Yes, backward looking, it has been correlated to risk assets. Why? Because there's been this monster thing. You've said it many times, Mike, and we all agree. We had the largest liquidity inflow in human history, and everything went up. Sure, everything was correlated due to that, right? Okay, that's gone. It may happen again if these guys are dumb, but whatever. And that's Larry's point, is that they are that dumb and they are going to happen. It is going to happen again, and whether it does or not. But take that out of the equation and now look at where you're at. And that to me is the biggest difference. There's a few things to keep in mind on the macro side. So one of the major things that's happened on the macro side that you wouldn't care about is inflows and outflows. And I'm not talking about ETFs now. I'm talking about the fact that Tether has been trading now at a slight premium for 4 days, 5 days. The last couple times that turned, that is basically, just so the audience understands, the reason Tether trades at a premium is because people outside the US, not inside the US, outside the US, need to get dollars into the crypto system to invest in crypto. Of that, Bitcoin gets a disproportionate amount, roughly equivalent to Bitcoin dominance. And so you have outside people buying into crypto. That is what's supporting the crypto market right now. Now, could that turn in a dime? Of course it could turn in a dime. But it's really important throughout all this uncertainty that you're seeing that. At the same point, foreigners are dumping stocks, as you both mentioned. So I mean, I just think that is a really important thing to think about.
I'm with Dave. I think Bitcoin is a very good bet for this year. I think gold continues to be a good bet for this year, although it's really had quite a move, and it could and should probably consolidate. I think the stock market's a bad bet. Bonds are kind of mixed. I mean, I hear your point, Mike, and you're right. Historically, they should drop, but I don't know if they will. It all depends upon how fearful of that future debasement, the typical bond investor is. And I would submit, based on what's going on, they should be pretty damn fearful, but they may not be. People get a lot of things wrong, right?
So let's have some discourse on that one. First of all, one of the most important things I've cared about always in this space, Dave, is what you mentioned, is not so much Tether, is the proliferation of crypto dollars. It reminds me very much, I was in Hong Kong in 2018, pointing out all the bear market stuff in cryptos and everything. And the key thing I pointed out as a bull market is Bitcoin dominance and the proliferation of crypto dollars. Tether was only $2 billion. Now it's a complete bull market. It's part of the reason I thought we had our president back then who thought it was silly internet money, who flipped over. It's like, what do you not understand about something who is base layer is $1 is investing in treasuries? He figured it out. He got it. That's my point, is what you said about earlier about all the inflows is one of the most bearish things I've ever heard, because they are expecting a profound shift in what's happened in the history of highly speculative risk assets, most notably cryptos, to diverge from its high correlation to the base layer, which is the stock market. Now, that is a call I will not make yet. I predicted it years ago. At some point, that's going to happen. They'll trade more Bitcoin, will trade more with treasuries. And then we saw Trump get elected, and we saw the massive proliferation of excess supply of cryptos and the massive hubris and the financialization of this space. It's way over leveraged long. So I'm just pointing out the same thing I did in 2018. I think Bitcoin can risk losing at zero. That's not profound. That's what it's been doing historically. So I'm sticking with what normally has happened. You both are expecting something that's very low probability. It's never happened before in history. Good luck with that one. I wish you luck. Maybe it'll happen. I want to see the proof. The first sign of that would be stock market going down and Bitcoin staying up on the year. I haven't seen that. That's my thought, is, okay, as a trader, test shorts here in that highly speculative risk asset the whole world's buying and thinks. And then I look at it, when you have an asset that absolutely can't go down, yet has a history of going down, you probably should be careful and look at it as a rational person. All right, I'll try a little of a put ratio spread in that type of position. Prove me wrong. I want to see the market prove that view wrong. I hope it proves you right. I hope it proves me wrong, but I fully expect the absolute rational thing. You're thinking about something very profound and unusual. The rational thing is expect normal reversion, protecting all cryptos. I think most of them will lose zeros. I think Ethereum's going to drop to around $200. It's just where it was in 2019-20. Not a big deal. It just got too expensive. It's a big deal for people who've long, but not for people like me who remembers internet stocks in 1999. Most of them went to zero. And then in 2007 and 8 in the housing market. So this to me is a normal expectation if the stock market goes down. Now, if the stock market drops 20% and Bitcoin's up, that is going to be a major, profound revolution. I don't think that's going to happen.
But it's been happening, Mike. I mean, just to look at the S&P.
Oh, short term, yeah. But okay, it happened how much?
Since year end. Bitcoin is flat, and the stock market's down 10%.
And gold's up 25%. So at the beginning of the year, we all pointed out, we knew it was expensive. I still think we should be overweight gold and risk off assets and underweight risk on assets. Bitcoin has a higher correlation to the stock market than it does to other cryptos in some cases, and it's very volatile. I'm like, good luck if it's going to outperform the stock market when it goes down. I mean, short term, sure.
What's the relative performance since November 1st?
Okay, you can pick a point in time. I'm just pointing on the year.
That's a really important point in time, right? Because that's when the regime changed, right? So it's not random. It's by November 1st, the markets that were pricing in Trump winning.
So okay, here's the key
market. I'm just asking a question.
Here's the key thing.
We can pull it up.
I'm going through it right now. I'm going to right now. I'm just pointing out the key thing I've been watching for a decade now is the Bitcoin to gold ratio. It's the same as 2021, the biggest pump in history. It got too expensive before we got it. Got down to 25, it's too cheap. Now it's bumping up near 30.
Can I make a point? Because there's a very specific, in the middle of your last soliloquy, you made something. You said a little sentence fragment, which I think is really, I want to pull at that thread. You said at some point it's going to be more like treasuries and more like gold. Well,
I said that's what I said in the past.
Yeah, okay. So fine. So for people who believe that that is true, understand that there has to become a transition for that to happen. That transition is you throw a zero on the back end of Bitcoin in order for that to be the case, right? And so the question is, if you have an asset which, in order to achieve that, now it may, obviously the probability isn't 100%. If it was 100%, it would be trading at 940,000 instead of 94,000, right? So the fact is, in order to get there, how does it get there? We talk about deterministic paths all the time. How does it get there? It has to do that. Now, will that happen? That's the question. So the question then is, what do we think about adoption for Bitcoin to become more like gold and more and really compete, in at least on the edges as gold does with treasuries and fixed income? That's the question. And that's where a fundamental disagreement is, I think. I mean, Larry,
Yeah,
do you agree with that?
Just to answer your question, I just ran the numbers quickly. I mean, since November, since Trump was elected, Bitcoin's up 55% and the market's down 5%.
Right. So, but it's important because the reason that I say that, Mike, isn't to be obnoxious, although I'm clearly am obnoxious. I get that. And I'm always tweaking you. So, I understand it. But the reason I'm saying it is when you pick a time, which is right before the inauguration, that we've already had the anticipatory blow off top, which clearly got overextended, and traders licked their chops, and smart people made a ton of money by shorting at that overextended first attempt to break out. If you normalize all of that, you kind of go back to November. And so 55%, it doesn't matter. The outperformance is dramatic. And that's really the point. Continue, but it's not going to continue in your point.
Mike's point's well taken. I mean, we've only got 6 months of data points or less. So we're early in the tank, but it is starting to occur. It is starting.
But the price setters are still going to be Mike's way.
Yeah, well, it's like we're at the good test now. My bottom line point is I've made predictions in the past that Bitcoin was going to add a zero. Now I'm fairly simply it's going to drop a zero because it already added the zero. Now has a good reason to give it back, partly because everybody's so bullish. The difference is now it has 14 million dependents. And every time you see those things go down, it pressures Bitcoin. Partly when you see all these allocations to Bitcoin, there is. Imagine the stop in this space. There's going to be hitting a market's always hit stops. It's a lesson, again, I learned from Charlie D. You go for the stops and then you buy it. I think it's more likely to hit the stop and then go back up than to just keep inching higher from here, because a lot of these people are in it expecting nothing but to go up, expecting past performance, which they've seen everybody get rich. It's usually how it works. They'll get stopped out and then it's the time to buy, like Amazon in 2002.
So let's go back 2000 for a second. I know, Larry, I know you're itching to tell Mike that all the people you talk to couldn't give a crap about altcoins and that Bitcoin, that they're not dependents. It's the other way around. That's the statistical relationship. But forget that. Let's go back to 2000, because I think that this year reminds me a lot. History doesn't repeat. Yeah. It does rhyme. And people who remember that we had a massive 14% sell-off in one day in March of 2000 in the NASDAQ. I was sitting on the trading desk at Solomon at the time, and that March was horrible. It was down significant, but the market, against all odds, with everyone saying, okay, people were doom predicting, ground higher into June, July, and then started a weekend, and then the fall was bad, and the whole next year was bad, with the crescendo of September 11th being when the markets reopened. After that was pretty close to the Pico bottom at that point. I mean, it was that. Now, do I think that we're going to have the same sort of thing now? No. Why? I think that it would be I think that this administration would prefer, and if you're going to have a crash in the stock market, for it to be in 2025, and for 2026 to be the rally off the bottom and make people forget what happened in 2025. Just like no one remembered when the election time, the Afghanistan debacle from Biden. People don't remember shit. I mean, they just, unfortunately, the entire electorate is like Dory in Finding Nemo. They're going to only remember 2026. And so what happens now, everyone keeps talking about, oh, this is going to have impact on the midterms. Sorry, but no. I wish that people were that smart that they could actually remember things, but people don't. And so I think that that's what we're looking at. You're right. I think this fall, and in this late summer, this fall, could be extremely ugly for what you like to term risk assets. I just think that will be the final proof of what's going on in Bitcoin, because I think it's first of all, there's two things about Bitcoin. It's really small relative to the stock market, meaning that if you're going to pick something to save, that's a hell of a lot easier to save. It takes a lot less capital to create the demand to that the supply just isn't there anymore, right? To sell. And second is it's not tethered to earnings. And we're all talking about a serious earnings recession, right? Does anyone disagree that we think that earnings in corporate America are going to have a real problem? Right?
I agree with that.
To me, that to me is my thesis. Now, maybe you're right. Maybe it's hopium. Maybe I'm wrong, and maybe there won't be liquidity coming in the back half of this. I think the market's anticipating too much liquidity now to hold up the stock market. I just don't see how we're not going to see a serious earnings recession. That to me is the issue.
Yeah, no, I think that's coming, and then the questions are, how does that ripple through all the other marketplaces? And it's to be determined, right? I mean, probably most importantly, the question becomes, where is that Fed put? Does it exist, and at what level? I mean, in 2020, in COVID, when the S&P was down 32%, he panicked and came in with all the guns. My sense is he doesn't want to have to panic, but my sense is also that if things get, we know, for example, there's some great things that have happened since I was last on your show. I mean, when the bond market got in trouble, and arguably in big trouble, and that's why they did the 90-day pause on the tariffs, correct? I mean, I think Bissett went to Trump and said, sir, we're losing the bond market. We can't have that happen. We got to pause this shit. And so they did. That could happen again. And if and when that does happen again, that's the third Fed mandate that I talk about in my book. I mean, that's when the big print will come in. So, the question is just how far does it have to go? How long does it have to take? And at that point, then Powell will have the political cover, and he'll be able to say, hey, yeah, I'm an inflation fighter, but look, we were in a serious problem here, and the house was on fire, and look at how I came in and saved it, just like Bernanke did. That's what's coming next. But the question is, what's the point at which that recognition takes place? And I don't know the answer to that. But I think that's in the next 6 months.
So, Mike, here's the interesting question. Does anybody, and we all anecdotally know people, do you know anybody that's involved in any company that sells goods, whether it's a retailer, a manufacturer, whatever? You know anybody who isn't afraid of being laid off? Anybody?
Well, that's the key point. It's not so much if they're actually getting laid off, it's your fear of getting laid off. That's a key thing that suppresses consumer spending. We all know it's a psychology of the human, and that is the fact right now. There's a guy in my condo who's French, and he works with a lot of import companies. He's glad he worked ahead. A lot of his competitors are getting hammered. But that's the key thing I think that's happening. I think if you just look at the lessons of history, when you get to 2 times GDP and the highest market cap ever versus the rest of the world, there's only 2 examples in history, 1929 in the US and 1989 in Japan. Maybe it's different this time. And I just point out that when this whole thing started with cryptos in 2009, and when the whole rally started in the stock market, they've been together on the way up. Same thing with the dollar. Everything's linked. Cryptos, Bitcoin, the dollar. Now they're starting to tilt lower. Certainly crypto indices. Now I do get it. Bitcoin is digital gold. Its market cap will, its dominance will increase. But when the whole space goes down, you don't want to be long a highly volatile risk asset. It has a history of trading with risk assets typically. And that's what's been happening this year. So let's look at flows in ETFs. There's maybe up to $4 billion total of inflows in Bitcoin. Yes, we've had a lot in the last few months, but there's almost $30 billion in gold. The thing is, we've had 4 years of outflows. That's my point is, I still think gold is going to be the better performer at the end of this year, better than Bitcoin. And most notably, if the stock market goes down, like again, we've seen that, and it's already bounced a little bit. That's my point. Is okay, prove it now. But the macro is, this is not anything we know the examples we lived through, but historically, I did live through the one in Japan. I remember trading there a lot. I remember a lot of my Japanese customers and people at IBJ, the people I worked with, they got it. They did well, but the general Japanese consumer didn't understand, and general Japanese didn't understand how expensive their market got. And now it's just it normalized. China is normalizing. It's U.S.'s turn.
Well, yeah, there's a couple things in there. First of all, Japan was fascinating, right? Because they were at PEs. I'll never forget. There's Business Week articles, all sorts of stuff. Look, I built the first index arb business on the street. I spent like the month of April of 2000, of what is it, 1985. God, it makes me feel old. But I spent the month of April at the Imperial Hotel as the kid programmer, building the ability to trade the Osaka 50 versus versus the stocks there, and sent over my team, to help build index arbitrage in Japan. And you went to the Japanese stock market and it was funny. So if you went to the TSE in those days, on days that the market was up, they literally would stand and clap. And when the market went down, it was like you could hear a pin drop. I mean, it was like such a, it was really, really interesting. There's like the national psychosis was about how the market was. And then that was right at the beginning of the time period where it dropped from 50 some odd thousand down to below 10,000. I mean, an 80% drop, top to, peak to trough. That's big. We've never seen that. It was crazy. So understanding that, but why was that true? Well, Japan had this thing called karetsu, which was the cross ownership of all the equities, and it was all tied down. And so the liquidity in the stock market compared to the liquidity in the futures market was really, really tight, and really, really small. So the futures were 5x more liquid than the stock market. And so what happened was the Japanese companies were not allowed to sell a share of the whole of this. And so they were kind of hamstrung. So the foreign companies came in and started selling futures. And of course that translated through to the stocks. And you ended up seeing this thing pinwheeling down and down and down. And that kind of locking in the market doesn't exist anywhere else. I have no idea what's going on in China. I'm not gonna lie. I have no idea if there's anything like that. But the reason I point this out is when you lock down your markets, bad things can happen. We don't have that problem here, right? That doesn't mean it can't rhyme, right? But it does mean that we don't have that problem. There's no structural reason for stock markets to underperform for decades like they had there. But even there, look at the yields that are in Japan. I mean, we freak out if it goes over, if their yields, potentially got to 2%, we look, oh my God, that'd be horrendous, right? What would they do? Think about that. Yeah, exactly. And so it's just a very strange. It's a very strange situation for us to understand, but it is different.
So let's back up on that. I mean, that's some great history and stories I really appreciate from you, Dave. So I just love doing the analysis on the top 3 major exporters in the world. You just mentioned one, Japan, China, and Germany. Their average yield of their 10-year note is below 2%, 1.8%. Germany's the highest at 2.5%. Yet their exports about 25% of their GDP. Germany is the worst. They're a complete export predator, 50% of their GDP. Getting hammered. And by the way, BYDs and Teslas are pretty good because compared to their internal combustion engines. Everybody, all the Toyota and Honda having a major problem. You see that deflationary thing. The key point is those 3 countries have GDP around 30 trillion, a little bit less, about the U.S. There's severe deflationary forces, and the U.S. has got one thing holding it up: its stock market. It's like that's why I look at it. I can't take that risk.
Can I ask you a question?
That market, and Bitcoin's part of that.
Let me ask you a question because specifically to that point, have your economists analyzed what is the correlation of consumer demand to the wealth effect, or how important the wealth effect is? For those who don't understand, I'm asking Mike about how much consumer spending is being supported by people who have their stocks that they're using to rely upon as opposed to jobs.
So I'll check in with that. I've looked at it. It's the highest ever in this country, particularly if you go back to 1929. Only the elite owned stock market, and they got hammered. But the key point I used last year is we created $12 trillion of wealth from the U.S. stock market. That's the most ever. It was 40% of GDP. And now this year we've only taken back about 5 trillion. Now we've taken back almost all of it for a little while, and we've bounced. It's unprecedented how much that will matter in the economy. It's no comparison. There's no way to really check in history because 1929 was the only example. Now everybody's in their 401ks. And now we all know that if you look at U.S. unemployment rate, it's a bull flag. We fully expect it to go near 5% by next year. That's our economics team. And that means people can't contribute to 401k if you're losing money. If your neighbor's losing money, you have to find other ways. It's just, this is a key case. There's no historical example. Just like the tariffs, there's no example of jumping this high of the amount of wealth that's related to the U.S. stock market in terms of the average human being in this country. It's uncomparable. Now, I'll check the economist team, but they'll just tell you what I said. There's nothing to compare to.
Yeah, no, that's right. It's quite a bubble, and I think we're on the same page about it bursting, Mike. I think we're just slightly different on how it's going to affect the bond market and the Bitcoin market.
Yeah, and I think that's
some
very
of that. It
relevant.
really comes down to what's the policy response. I mean, you show me what the Fed does. And,
the big print.
I mean, we could, if the Fed wants to sit on its hands and watch the whole thing crumble, yeah, I mean, everything's going down.
But it's the point. It's the point. Okay, so we all know started it with the 1987 stock market crash when Greenspan eased 50 basis points that day. Now we've reached the point of maximum return. We've reached the point where, okay, we've created way too much liquidity, and we found that the risks of inflation. We still have too much liquidity and inflation in risk assets. So the Fed knows that, and that means that it's now just back to the normalization period. And I think I like to call it, we have the high, I think we've had the macro high price cure. You've seen this commodities on an annual, maybe more than a couple year cycle. Now I think it's happened in the equity market. We've seen the high price cure. Now we have to find out where the low price cure is. It fully expect the Fed will ease, but they're kind of behind the curve right now. When they do ease, it'll be a lot. They'll go 50 at a clip. And then we'll get to a point, I think, where it's going to stay down for a long time, but definitely it bounces because we've realized, okay, we've learned all those lessons of history of too much liquidity and inflation. The Fed, and they'll buy bonds. It's what they always do. Why should that stop?
So it's funny.
Because the policy response will make buying bonds a suicide mission. That's what I would say.
Well, no, when it's your market, come on. What did we do during World War II, and even after World War II? We didn't have a big print, but we got out of that. We grew out of it.
Well,
by exporting. Part of it was exporting.
That was a completely they did yield curve control, but it was a completely different situation. I mean, they had a much better demographic picture, and they weren't running enormous budget deficits. I mean, the minute the war ended, the budget went into a surplus. So that's what saved us there. We can't get this budget into a surplus without wiping out 50% of boomer entitlements, and that's not going to happen. So it's not at all comparable to World War II.
Well, we used to have a saying when I was in the bond pits that supply drives bull markets, and the lessons were Japan and China now. I mean, their GDPs are much higher and they have the lowest rates, but they're exporters. So I got to see that beef of having deflation in actual, even though we have more supply and actually have bond yields going up, that's really never happened in this country. And if it happens, great. It'd be like Bitcoin going up and the stock market going down. It's never really happened in a long-term picture. I'd like to point out that there's only been 2 down years in S&P 500 since 2008. That was 2018, 2022, and each time Bitcoin went down many X's the stock market did. So like I said, it's just, let's see it. It's usually doesn't happen that way.
It's going to have to separate, no doubt, but it's in the process of starting that.
So it really is. Yes. When you talk about it from a policy point of view, the question becomes, how does the government respond? Look, we all keep saying the same thing. What I think are 2 things. One, we don't know, and it's very uncertain, what they're going to do to help the supply chain dependent companies. What we saw in the pandemic was we learned something. And unfortunately, it looks like they didn't learn this lesson. At least Peter Navarro didn't learn this lesson, which is sad. But we learned the lesson that the economy is very interdependent, and we are massively dependent upon certain exporters, not just for finished goods, but for parts inside of goods. We didn't learn that lesson, or he did not learn that lesson, but the world did. And the Fed had to come in and do what they did because people were going to be out of work all across. And there was, at the same time, shortages driving inflation. What is the most inflationary thing that we can do into our economy? We could screw up supply chains. We learned this. Navarro did not learn this. He needs to go to remedial 7th grade, 8th grade, middle school econ to remember to learn this. And the reality is we have the Secretary of the Treasury probably using those words to President Trump saying, President, with all due respect, we learned we can't screw up supply chains. We need to moderate. And so I think that's what you're seeing. Sorry about that.
Good
I
point.
think that's
I mean,
what you're seeing.
some have compared this to COVID too. You know, it's almost the same thing.
But what does that mean? That means that we are the reason the Federal Reserve is like, what the hell, guys, is if you do things that are going to be massively inflationary, not because of the tariff one-time jump. If you just did a 10% across the board tariff, no, but this wouldn't have happened. This was not about that. This is about uncertainty of where you could get your finished goods from, where you could get your parts and components from. This is about screwing over supply chains. And China is way too important embedded in all our supply chain. You know, as I said, I talked to people in 3 different industries over the last week. You know, apparel, you know, a piece of tech, and machine goods. And they all said the same thing. They all said that they're afraid that they're not going to be able to even get the components they need to get to be able to sell stuff. That's really important because that's massively inflationary, even for way beyond the effect of the actual tariff. So that's what's doing. So we'll see. So if the administration recognizes this and fixes it, that could be a big deal. But the other big deal is that is almost certain to create a dramatically higher amount of economic pain, right, than people think. So I'm not saying that's going to happen. I mean, but I am saying that it could happen.
But that's an analogy I like to use. I remember in 2008 when the price of crude gasoline, just saying this average price went up to $4 a gallon. That's only 3, so that shows it's and it was like July. Crude oil went to its all-time high of 140, and by the end of the year it was trading $40, and the average price of gasoline was below 2. That to me, it's now I think it's worse because it's the whole supply chain thing when you can't get your Christmas lights. But that's also a short-term thing. By come a year from now, we'll finally realize, oh, you know, we don't have to just offshore. There's ways we can create things in this country or near shore. But right away, right now, that's the key bent, I'd say, is it's towards a normal, way overdue recession that we didn't get in 2023. Now we have a great catalyst for it. And I look at it as this year's don't be beholden to any long positions unless it's risk off assets and look to be trading tactically. And so far that strategy's worked out really well, and I stick with it.
Yeah, no, I get that. I get that. I mean, it's funny. There's one of the comments we got on Twitter was from Joe Carlosar, and he's like, the market's only down 10%. These guys are predicting a market crash. I can't believe how bearish we all are. I want to be exceedingly clear from my perspective is we are careening toward that direction in my point, unless there's a policy change. Right. I think that earnings is going to have a serious earnings recession, which will get reflected in the market to see somewhat, unless policies change and we get easy money. If you get both of those things, I think you can rescue the stock market, but I think you need to do both. I think you tell me, what do you think, Mike? I think you think that it doesn't matter, and I think, Lawrence, you think it doesn't matter.
Here's the problem. If we rescue the stock market, eventually it's going to happen. It always has happened in history. You have to normalize when you have way overvalued risk assets. And the U.S. on the global basis and historically is the sore thumb, the U.S. stock market. Everything else trickles down from the cryptos are part of it. I think the process has started. Yes, if I'm a trader, I probably need to get stopped out a few times before it goes the right way. What I remember the first time I worked with Marty Schwartz. But right now I look at it, it just seems too easy as the first short was Bitcoin getting unchanged on the year after it seemed too easy when it was at 60 to buy it. Now I don't trade anymore. I just look at it, this is what I hope I would have done. But that's what I think the market's looking at it. And the thing is the masses I don't get it, but what I think the masses do on a global basis are selling U.S. stocks on rallies. And because they have to, it's prudent, unfortunately, now.
Right. Larry, your final thoughts?
No, I'll stick with my bearish guns. I think that this isn't going to be a good year for the market. And I think it's going to be a good year for, sound money, which is gold and Bitcoin. So, it's to me, it's a pretty simple strategy. Also good for gold stocks. The gold mining industry is just terribly undervalued. And you sound
like Peter Schiff.
Gold miners are going to become the new central banks. I mean, they produce sound money, and central banks.
Well, they do so by pulling it out of the ground at enormous costs of energy. Which, Mike, I think you're still calling for oil to drop significantly.
Well, see, that's not profound to say it. It has in the last 20 years. There's an excess of supply. Demand is declining. And who we have a vested interest in going lower. So $62 a barrel. Yes, I made the call way too early. If you keep saying you'll be right, I think it gets to 40. Even natural gas pumped up to 4 this year. Typically bottoms near 2. We had a colder than normal winter. Are we going to get that 2 years in a row in a global warming environment? It's more likely head that way. All the grains have had a decent, a massive supply coming out of Brazil. Why? Because the prices pumped up, and they're all heading towards a low price cure. Unless we get a drought this year, they're all going lower. That's my point. This is just a normal trajectory. You need some kind of shock.
We need to dig into that a different time. It's time to wrap, but we'll see what happens with the U.S. food supply, what RFK does, because there's going to be some interesting things going on commodities. The only point I'll make on oil is simple. It's in $25. What is 40 from history, given how much monetary debasement there is?
Massive deflationary. Crude oil is one of the most deflationary commodities. It's a major commodity, but it's completely, I mean, the price we see on the screen was first traded in 2005. That just shows you how humans create more with less every day. And the problem is now we're using less. I mean, it's just the fact I say my plug-in hybrid is 11 years old.
Can I ask one question?
Yeah.
The one question I'll ask is, what was the cost of production the last time last time oil was at 40?
The last time,
what is it today?
It's about $50 a barrel break-even cost, and it's been, our data goes back from about 10 years. It's been dropping from 70. It's the rapidly advancing technology of drilling technology. Drill one drill now, and you can go out horizontals, 20 of them for 4 or 5 miles. It's just unstoppable. Well, now the rest of the world's adopting that, and even China's adopting our techniques in EVs and genetically modified seeds and things. It's just humans create more. It's superabundance. There's a great book about it. It's a wonderful thing for consumers, but bad for prices. It's very.
But it is good for inflationary expectations. That is good. But anyway, we could go on forever. Anybody have anything final to say, or we'll wrap it here and we'll see you all next week. I think Scott will be back from his jaunt to Dubai, then down to Miami for Formula One. He's racking up the frequent flyer miles.
Thanks, Mike. Thanks, Dave. It's always good to talk to you, Mike. I really appreciate your perspective. Thank you.
Thank you.
Thanks, guys.
Thanks, Dave.
Take care.
Thanks, Dave.
Let's go.